She started investing at 62 years old with just $15,000. Everyone told her she was too late. Her friends said she had missed the boat. Her brother told her to just keep the money in the bank where it was safe. Even a financial advisor she consulted shrugged and said there wasn't much point in starting so late in the game. That was 12 years ago. Today, Margaret is 74 years old, and that initial $15,000 has grown to over $93,000. But here's what's even more remarkable. She didn't stop at that first investment. Over the years, she continued adding small amounts, learning as she went, adjusting her strategy as her confidence grew. Her total portfolio today is worth over $400,000, built from scratch, starting at an age when most people assume it's too late. Margaret isn't a financial genius. She doesn't have an economics degree. She didn't inherit money or get lucky with a hot stock tip. She simply learned a set of principles that work specifically for people over 55, applied them consistently, and let time do its magic. And today I'm going to share those exact principles with you. If you're over 55 and you've been telling yourself that you missed your chance to build wealth, that the ship has sailed, that investing is only for young people with decades ahead of them, I need you to pay very close attention to what I'm about to share, because everything you believe about being too old to invest is wrong. And by the end of this video, you'll have a clear, actionable strategy to start building wealth today, regardless of your age. Before we dive into this life-changing information, I need you to do something. Drop a comment right now telling me where you're watching from and your age. I want to know who's in this community. I want to know who's ready to take control of their financial future. And if you believe that it's never too late to improve your life, hit that subscribe button and the notification bell. This channel is dedicated to helping people build wealth at any age. And trust me, you don't want to miss what's coming. Now let's destroy the biggest myth holding you back. The myth that you're too late is probably the most destructive financial belief anyone over 55 can have. It's a lie that keeps millions of people paralyzed, watching their savings lose value to inflation while they convince themselves that doing something is pointless. Let me give you some perspective that might surprise you. If you're 55 today, your average life expectancy is another 25 to 30 years. That's not a short time. That's decades. If you're 65, you likely have another 20 years ahead of you. Even at 75, statistics suggest you have more than a decade of life remaining. Now think about what the stock market has done historically over 10, 20, 30-year periods. Despite wars, recessions, pandemics, and financial crises, the market has never failed to deliver positive returns over any 20-year period in its entire history. Never, not once. So when someone tells you that you're too old to invest, what they're really saying is that the next 10, 20, or 30 years don't matter, that the money you could build won't make a difference, that your future self doesn't deserve financial security. That's nonsense. Your future matters. Your financial security matters. And there is absolutely enough time to make meaningful progress. Let me share some real numbers to prove this point. If you're 55 years old, and you invest just $500 per month into a diversified portfolio, earning an average of 7% annually. By the time you're 70, you'll have accumulated over $158,000. That's money you didn't have before. That's security you built yourself. If you can invest $1,000 per month, that number jumps to over $316,000. What would an extra $300,000 mean for your retirement? What would it mean for your peace of mind? What would it mean for the legacy you leave behind? And those numbers assume you're starting from zero. If you already have some savings that you can invest, the numbers get even more exciting. The point is this: you have more time than you think, and even modest investments can compound into significant wealth over the years you have ahead of you. Now let's talk about the strategy. Because investing after 55 requires a different approach than investing at 25. Your goals are different. Your timeline is different. Your risk tolerance should be different. And the opportunities available to you are actually different too, often in ways that work in your favor. The first principle of investing after 55 is what I call the bucket strategy. This approach divides your money into 3 distinct buckets based on when you'll need it. Bucket 1 is your safety bucket. This contains money you'll need within the next 1 to 3 years. This money should not be invested in the stock market at all. It belongs in high-yield savings accounts, money market funds, or short-term CDs. The goal here isn't growth. The goal is preservation and accessibility. If the market crashes tomorrow, you need to know that the money you're counting on for near-term expenses is completely safe. How much should be in this bucket? A common recommendation is to keep 1 to 3 years of living expenses here. So, if you spend $50,000 per year, you'd want $50,000 to $150,000 in your safety bucket. This gives you breathing room and prevents you from ever having to sell investments at a bad time. Bucket 2 is your income bucket. This contains money you'll need in 3 to 10 years. This bucket should be invested more conservatively than an aggressive growth portfolio, but it still needs to grow faster than inflation. Bond funds, dividend-paying stocks, and balanced funds work well here. The goal is steady, reliable growth with moderate risk. You're not trying to hit home runs, you're trying to build a reliable income stream for your retirement years. Bucket 3 is your growth bucket. This is money you won't need for 10 years or more. And yes, even at 55, 60 or 65, you can and should have a growth bucket. This is where you invest in diversified stock funds, index funds, and other growth-oriented investments. Because you won't need this money for a decade or more, you can afford to ride out market volatility and capture the higher long-term returns that stocks provide. The bucket strategy gives you the best of both worlds. You have safety and security for your immediate needs. You have steady income building for your middle-term needs. And you have growth potential for your long-term future. The second principle is to maximize your catch-up contributions. Here's something beautiful about being over 50. The IRS actually gives you special privileges when it comes to retirement accounts. If you're 50 or older, you can contribute an extra $7,500 per year to your 401k, above the standard limit. That's a total of $30,500 for 2024. If your employer offers any matching, that's free money on top of what you're contributing. For IRAs, the catch-up contribution is an extra $1,000, bringing your total allowed contribution to $8,000 per year. These catch-up provisions exist specifically because lawmakers recognize that people over 50 need the ability to accelerate their retirement savings. Take full advantage of them. Every dollar you contribute reduces your taxable income today while building your wealth for tomorrow. And if you have a spouse who also works, you can potentially double these numbers. A married couple over 50, both maxing out their 401ks with catch-up contributions, can shelter over $60,000 per year from taxes while building their retirement nest egg. The third principle is to embrace dividend investing. For investors over 55, dividend-paying investments offer something magical. Income you can use today while your principal continues to grow. Think about it this way. If you invest $100,000 into a portfolio of quality dividend stocks yielding 4%, you're generating $4,000 per year in income. That income arrives whether the market goes up, down, or sideways. It's cash in your pocket, deposited regularly into your account. But here's what makes dividends even more powerful. Quality companies tend to increase their dividends over time. A company paying a 4% dividend today might be paying 5% in a few years. Your income grows even if you don't add another penny to your investment. And if you don't need the income right now, you can reinvest those dividends to buy more shares, which pay more dividends, which buy more shares. This compounding effect accelerates your wealth building significantly. Some of the best dividend investments for people over 55 include dividend aristocrats, which are companies that have increased their dividends for at least 25 consecutive years. These are stable, well-established companies with long track records of rewarding shareholders. Names like Johnson & Johnson, Procter & Gamble, Coca-Cola, and dozens of others. There are also excellent dividend ETFs that give you instant diversification across hundreds of dividend-paying companies. These are simple, low-cost, and effective ways to build a dividend income stream. The fourth principle is to understand and use tax-advantaged accounts strategically. After 55, your tax situation becomes more complex, but also more full of opportunities if you know how to use them. Traditional IRAs and 401ks let you defer taxes until retirement. The money you contribute reduces your taxable income today grows tax-free for decades, and then gets taxed when you withdraw it in retirement. For many people, this is advantageous because they expect to be in a lower tax bracket in retirement. Roth IRAs and Roth 401ks work the opposite way. You pay taxes on the money today, but all future growth and withdrawals are completely tax-free. If you believe tax rates will be higher in the future, or if you want flexibility in retirement, Roth accounts are powerful tools. For people over 55, there's a strategy called Roth conversion that can be incredibly valuable. This involves converting traditional IRA money into a Roth IRA, paying the taxes now at your current rate, and then enjoying tax-free growth and withdrawals forever. This is particularly smart in years when your income is lower than usual. Perhaps you've retired early but haven't started Social Security yet. Converting during these low-income years means paying less tax on the conversion. The fifth principle is to keep your costs low. Investment fees might seem small, but over time they devour your returns. Consider this example. If you invest $200,000 and earn 7% annually, but pay 1% in fees, after 20 years, you'll have about $612,000. But if you could cut that fee to just 0.1%, you'd have over $723,000. That's over $100,000 difference just from reducing fees. For investors over 55, every dollar matters even more because you have less time to recover from unnecessary costs. That's why I strongly recommend low-cost index funds and ETFs from companies like Vanguard, Fidelity, and Schwab. These investments often charge less than 0.1% in annual fees, leaving more of your money working for you. Avoid high-fee mutual funds. Avoid expensive annuities with complicated fee structures. Avoid any investment where you don't clearly understand what you're paying. The sixth principle is to protect yourself from sequence of returns risk. This is a concept that most young investors never need to think about, but for people over 55, it's crucial. Sequence of returns risk refers to the danger of experiencing poor investment returns early in your retirement, right when you're starting to withdraw money. A market crash in your first few years of retirement is far more damaging than a crash 10 years into retirement, even if the average returns are identical. Here's why. When you're withdrawing money in a down market, you're selling shares at low prices. This depletes your portfolio faster than expected, and you have fewer shares left to benefit when the market recovers. The bucket strategy I mentioned earlier helps protect against this risk. By having several years of expenses in safe investments, you never have to sell stocks during a downturn. You simply live off your safety bucket while your growth bucket recovers. Another protection strategy is flexible withdrawal rates. Instead of withdrawing a fixed dollar amount every year, you adjust your withdrawals based on market conditions. In good years, you might take a bit more. In bad years, you tighten your belt and take less. This flexibility dramatically improves the odds that your money will last. The seventh principle is to consider part-time income as a wealth accelerator. One of the biggest advantages people over 55 have is experience, skills, and knowledge that others will pay for. Working part-time in retirement, even just 10 or 15 hours per week, can have an enormous impact on your financial security. Every dollar you earn is a dollar you don't have to withdraw from your investments. This lets your portfolio continue growing instead of being depleted. But beyond the direct income, working part-time often provides other benefits. It keeps your mind sharp. It provides social connection. It gives you a sense of purpose. Many people find that a few hours of meaningful work actually improves their retirement experience. The gig economy has created countless opportunities for flexible, part-time work that didn't exist a generation ago. Consulting in your field of expertise, tutoring, freelance writing, driving for ride-share services, renting out a spare room, the options are endless. Even earning just $1,000 per month from part-time work could mean leaving an extra $12,000 per year in your investment accounts to grow. Over 15 years at 7% returns, that's an additional $300,000 in wealth. The eighth principle is to plan for healthcare costs. This isn't directly about investing, but it's so important for people over 55 that I have to address it. Healthcare is one of the biggest expenses in retirement, and underestimating it can destroy even a well-planned financial strategy. The average retired couple will spend nearly $300,000 on healthcare in retirement, and that's on top of what Medicare covers. Make sure your investment strategy accounts for these costs. Consider a health savings account if you're still eligible, as these offer triple tax advantages: tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. Money in an HSA can be invested and grown just like an IRA. Also consider long-term care insurance while you're still healthy enough to qualify. The cost of nursing home care can deplete a lifetime of savings in just a few years. Insurance won't cover everything, but it can provide a critical safety net. Now let me give you a practical action plan you can start implementing today. Step 1. Calculate your numbers. Figure out how much you currently have saved, how much you can realistically contribute going forward, and how much you'll need in retirement. There are many free online calculators that can help with this. Step 2. Set up your buckets. Divide your current savings and future contributions into the 3 buckets we discussed: safety for short-term needs, income for medium-term needs, and growth for long-term needs. Step 3. Maximize tax-advantaged accounts. Before investing in taxable accounts, make sure you're taking full advantage of 401ks, IRAs, and catch-up contributions. Step 4. Choose low-cost investments. For most people over 55, a simple portfolio of 3 to 5 low-cost index funds can provide all the diversification you need. You don't need complicated strategies or expensive advisors. Step 5. Automate everything. Set up automatic contributions to your investment accounts. Automatic investing removes emotion from the equation and ensures you're consistently building wealth. Step 6. Review and adjust annually. Once a year, review your portfolio allocation, rebalance if needed, and adjust your strategy as your circumstances change. Let me tell you about Robert. Robert came to a financial literacy workshop I hosted when he was 58 years old. He had $40,000 in savings, no retirement accounts, and he was convinced that it was too late for him to build any meaningful wealth. I walked him through the exact strategy I've shared with you today. He was skeptical at first, but he committed to trying it for 1 year. Robert opened a Roth IRA and maxed it out with catch-up contributions. He set up automatic investments into a simple 3-fund portfolio. He started doing some consulting work on the side, earning an extra $1,500 per month, which went straight into his investments. After 1 year, he had grown his $40,000 to over $60,000. After 3 years, he was at nearly $120,000. Now, 7 years later, at 65 years old, Robert has over $280,000 in investments. He's still working part-time because he enjoys it, still contributing to his accounts, and his portfolio continues to grow. Robert's life is completely different now. He has financial security he never thought possible. He has options he never thought he'd have. And it all started when he stopped believing the lie that he was too late. You can be the next Robert. You can be the next Margaret. You can write your own success story, starting today. The truth is, the best time to start investing was 20 years ago, but the second best time is right now, today, this very moment when you're watching this video. Every day you wait is a day of potential growth lost. Every excuse you make is an obstacle between you and financial security. Every doubt you harbor is a chain keeping you from the future you deserve. You are not too old. You are not too late. You have everything you need to start building wealth today. The only question is, will you take action? If this video has opened your eyes to what's possible, if you're feeling motivated to take control of your financial future, I need you to do 3 things. First, hit that like button. It helps this video reach more people who need to hear this message. Second, subscribe to this channel and turn on notifications. I'm constantly creating content to help people build wealth at any age, and I don't want you to miss a single video. Third, drop a comment below telling me your age and one action you're going to take this week to start investing. When you write it down and share it publicly, you're far more likely to actually do it. Plus, I read every comment, and I'd love to celebrate your commitment. Remember, your age is not a limitation, it's an advantage. You have wisdom, experience, and clarity that younger investors lack. You know what matters in life. You know what you're working toward. And you have every reason to succeed. The next chapter of your financial life starts now. Make it a great one. I'll see you in the next video.